Wall Street Journal article on Thursday, summer rally puts the hurt on hedge funds and actively managed mutual funds. I thought this would be a good time to revisit investment philosophy, the difference between hedge funds, active management, and then passive management, which is what we embrace here at Financial Harvest Wealth Advisors. The article pointed out that in the last year, the year to date, the S&P 500 is up 11.6%. Meanwhile, the average actively managed large cap fund is only up 6.9%, and a typical hedge fund is only up 2.6%. That's a difference of 9 percentage points over these last 9 months, or think of it this way, that's $90,000 of sub-performance on $1 million account. Why is that? They've been market timing. A lot of them have been out of the market during this recent rally. This example shows if you invested $1 back in 1926, if you stayed fully invested, that $1 grew to over $3,000. But if you invested and you market timed and you missed the best month of returns each year, it only grew to 2.77 or $2.77. A huge difference in wealth by market timing because returns are clustered and they're concentrated when we least expect them. The other story though is expenses. Notice that a hedge fund, since they charge what we call 2 and 20, 2% of assets plus 20% of your returns. If you're earning 8%, let's say, gross per year, they're taking 3.6 in fees. An actively managed fund is going to take somewhere around 1.5%, and then a passively managed fund like we embrace here is going to only take 0.3%. Those differences in costs and expenses, when you compound that out over time, this is on $1 million account over 20 years, the difference in the growth potential is somewhere over $1 million between the actively managed mutual fund and a passive approach, and it's almost $2 million when you're looking at a hedge fund versus a passive approach. Significant difference to your wealth potential. So I leave you with 2 truths. Number 1 is that returns are concentrated and come in clusters when we least expect them. We can't market time or we'll miss those. Secondly, as we've always said, cost and expenses matter to the tune of millions of dollars when you compound that out over your investment lifetime. As we always say, your investment survival is on the line. Invest wisely.